Okay. Welcome, Michael. Thanks a lot for coming onto our podcast show. It's great to have you on the show for the first time.
Thank you. It's very nice to be here.
Great. Michael, what I like to do to start with is, I like to ask guests something about their background. How did they first enter finance and economics? Why was that the area of interest that you had, when you were younger, as you were entering university? And then, something about your early career on the buy side and later career on the buy side and some of your more recent work that you've been doing. So it'd be good to kind of get your story.
All right. Yeah, sure. And I guess my early story is a common one. I really didn't have a clear view of what I wanted to do when I went to university. And then I took a class from a great teacher, intermediate microeconomics class. And I thought, wow, this is really interesting. So I'm going to major in economics. And so that pushed me. That was my first push in that direction. And then after I got into it further, I decided, I really like this and I want to continue. I want to be a professor. I love being on university campuses. I love the academic environment. So then I went all, through for a PhD and was a university professor for many years and rose to a tenured full professor. And I had a great job. And I used to tell my wife, they're going to carry me feet first out of this office. So but I've had a very unconventional professional life because after becoming a tenured full professor, I got an invitation one day to come talk about my research at Barclays Global Investors, which was world headquartered in San Francisco. And so I was writing academic papers on international finance, in particular global equity markets and the foreign exchange market. So I went to San Francisco, went to BGI, gave a noon-hour brown bag seminar on what I was working on, spent the day there. Then that night at dinner was asked by the head of a global macro hedge fund, he said, could you ever imagine working at a place like this? And I said, wow, before I came here, absolutely not. I love being a professor, but having spent the day here, yeah, it was very different than I expected. BGI was a very almost academic-like institution. Terms of how they pursued research and went about their research. And so, it opened my eyes. And then a couple of months later, they invited me back to meet with the CEO and they recruited me to join. And so I joined at a very senior level as head of currency research and head of currency hedge funds. So it was a real learning experience because academics tend to be very arrogant and think they know more than it turns out we actually know, because I didn't know what I didn't know until I became a practitioner and moved to that side, running currency hedge funds and building quantitative models for trading. So every day I was learning new things and it was just fascinating. So I resigned my position at the university. My academic colleagues said, are you crazy? You're a tenured full professor, you're walking away from this for the uncertainty of financial markets. I said, yeah, that's what I do.
What period was this? What years, what sort of period is this?
That was, I joined BGI August 1st, 2005.
Okay, yeah.
So I left academia, and then of course BGI was bought by BlackRock in 2009. So then became the big West Coast quantitative office of BlackRock. And that was wonderful. BlackRock's a great firm. I'm very proud of my years at BlackRock, loved working there, great colleagues, a great firm. And I was very happy there. For years, I had exactly the same job, same team, half my team in San Francisco, half my team in London, spent a lot of time in London. And then there was a restructuring at BlackRock and I was moved to the executive group of multi-asset strategies, where I got to work with both quantitative investors and for the first time fundamental investors. And I really learned a lot from working with the fundamental investment teams and developed a great appreciation for their skills. So that was great. And again, I had a great job. I loved working at BlackRock. And then the University of California, San Diego was starting a new Master of Finance program, and they wanted it to be a quantitative Master of Finance program. So I had been teaching in the Masters of Financial Engineering program at UC Berkeley. So I was familiar with the curriculum for these sorts of programs.
Mm.
So I hired quantitative researchers at BlackRock. So I knew what industry wanted people to have, and I also knew what would be the key curricula. So I got a couple of calls from the senior finance fellow at UC San Diego asking me about programs as they were planning their program. And then after the second call, he said, hey, would you consider leaving BlackRock and coming down here and getting involved? And so once again, I wasn't looking for a job, something just came to me, and I thought, all right, I'm willing to, I was happy to go back to academia, and I always thought I would go back to academia. So when the UCSD opportunity presented itself, my wife and I talked and decided, okay, we're moving to La Jolla. I'm going back to academia. And now my BlackRock friend said, are you crazy? You're doing this? Aren't they going to pay you a lot less? And I said, yeah, that's true. So I've come full circle.
Yeah. And you mentioned that you learned a lot on the fundamental side when you moved to the multi-asset role at BlackRock. What was some of the important things that you learned there compared to, obviously you have more of a quantitative, systematic kind of approach to investing. What were some of the key things you learned?
Yeah, well, a great appreciation for how they do their screens. They weren't quantitative. They would use quantitative tools. They use them differently. Like on my team, when I was in charge of the currency business, we were building quantitative trading signals and automating everything, feeding it into the model, optimizing a model every day, subject to transactions cost and risk metrics, and then we would trade what came out of our model. And the fundamental investors, they're not optimizing any models, but they do employ quantitative tools in the various screens that they would build in order to identify trading opportunities. And part of my role, the biggest part of my role, was really coordinating research across multi-asset strategies. And with the fundamental investors, that would mean helping them develop their quantitative tools and discussions with their research staff that would help promote the development of further skills in those areas and further tools for them. So, ultimately there's a PM leader who makes the decisions.
Yeah.
But the team that works in that group would identify trade opportunities and in a sense would pitch those trade opportunities to the senior PM who would have ultimate say. But I developed a great appreciation for how you build these sorts of tools and you can employ them. There are many ways to succeed here, and the hardcore quant way that I had always been familiar with is not the only way.
Yeah. And did you find that the risk return characteristics of the fundamental approaches was different to the quantitative approaches? I mean, was there diversification in employing both approaches?
Yeah, and to me, that's the scarcest resource in the fundamental world. How do you size your trades?
Yeah.
How do you put it all together? When you have the quant model, you're doing it, right? You've got a covariance matrix and you've got your alpha signals and you put it all in and mix it up in the optimizer and out comes your holdings, right? So to hit a particular risk target. With the fundamental investors, it's more of, all right, how big do we want to go on this? If we do that, how will it affect our overall portfolio? And at BlackRock, we were very fortunate because every investment team has someone from risk management sitting with it who can do those diagnostics, and they can advise you and help you in assessing what will this do to the overall risk of the portfolio, what will our risk level be if we add this trade to the portfolio, and what's the expected correlation with the rest of the portfolio. So sizing the trades to me is always this part for the fundamental, identifying the trades. Of course, if you don't have the right trades on, you cannot succeed, but then getting the size right is really important.
Yeah. And we'll talk a bit more about that later in relation to some of your more recent academic work. But I guess let's kind of go back to just something a bit more fundamental, I suppose, or foundational or philosophical, which is currencies is one of those one of those markets, I should say. I don't want to sort of prejudice my question here, but it's one of those markets which people tend to view as something that is a byproduct of other markets. People understand bonds and equities as there's an asset that you're buying. In the case of equities, you can imagine a future stream of dividends. There's a company, there's earnings, revenues, and so on. So you can see, how you can value that, and you can see its performance over the years. Bonds, equally, you earn a coupon on the bonds, there's an interest rate, and so on. Now, FX, is it really an asset class or not? I mean, is it a source of alpha or beta, or whatever term you want to use? How do you go about answering or thinking about that question?
Yeah, that's, there are different views in this area. And certainly historically, currencies were viewed in the manner that you suggested, Bilal, that they were a derivative.
Yeah.
You want to buy if I'm in the US and I want to buy Japanese bond or Japanese equity, I need to buy Japanese yen. Or I'm a corporate and I have a payable due to a supplier in Japan, I need to buy Japanese yen to settle that payable. So that's the historical way, I believe, that people viewed currencies. And slowly over time, I think it evolved. And that happened in the early 2000s. Before I left academia and moved to BGI, I think the market was starting to embrace the concept of currencies as an asset class, a separate asset class. And when I got there, when I left academia in 2005, BGI had established some currency hedge funds, which were doing quite well. And so I took over those funds when I moved in to the firm, and we grew them dramatically. This, to me, was the heyday of currencies being viewed as an asset class. It was new. It was not something institutional investors had had in their portfolio, but there was great interest around that time in currency overlays on global equity portfolios, as well as currencies as a separate uncorrelated source of alpha. And so this was the heyday, the pre-financial crisis era, I see as the heyday of currencies as an asset class and money flowing in to that space. So to me, if you have a multi-asset portfolio, you've got equities, bonds, commodities, and currencies. It is the completion asset, if you will, in a multi-asset portfolio.
And then in terms of systematic source of investment returns, what, in your view, are the more robust sources of returns in currencies? People often talk about the carry trade, there's trend following or momentum, valuation-based models, and so on. In your view, what do you think are the core robust sources of systematic returns?
Well, certainly it is true there are so-called generic signals in currencies, which would be carry, momentum, and value. And those have been well known for quite some time. However, there are different ways to approach each of those. And there are many alternative, reasonable ways of constructing a carry trade position or a momentum signal or a value signal for currencies. And the secret sauce, I think, for successful investors is to have done their homework and have a view on, what is maybe a proprietary construction of carry, momentum, and value. But that said, there are well-known approaches, like you were once at Deutsche Bank, and here's a plug for Bilal, by the way. He was one of my favorite sell-side analysts. There were, more than once I walked around the block from our London office to London Wall to go to Deutsche Bank to visit with Bilal and colleagues. So Deutsche Bank has a currency index that they maintained that was a generic carry, momentum, and value. I don't remember what it's called, but
it was called something I built, I worked on, which was the DB Currency Returns Index, or DBCR, which was a generic carry plus momentum plus value model.
Yeah, And I think that some people started to view that as a kind of benchmark
Yeah.
for currency investors. And I have very strong views on benchmarks for currency investing and how to measure performance for currency managers. But I think that's a good example, you know, where you can have a diversified, even suppose you have a three signal portfolio,
Yeah.
carry momentum and value, like the one you built at
Yeah.
Deutsche. Then you see periods that gives you some diversification. At times, they're all performing well. At other times, one's doing okay, two are not. And having the three signal portfolio is better than a one signal portfolio over the long run. And, you know, I've talked to academics who say, yeah, if you have the exposure to those three just generic signals, look, over the long run, it goes up, the cumulative returns. And I said, that is true. But when you're managing other people's money, you see those drawdowns that
Yeah.
occur. That's when they can pull the money from you, right? So
Yeah.
you have to get through those. Uh, yes, in the long run, you do get positive returns, but you either need deep pockets to weather the drawdowns, or you need the strong will and commitment to staying with it for the long term. And when you have a deep enough drawdown, you know there are people who have to bail out
Yeah.
because they're getting hit with margin calls or whatever.
And say on the carry trade, there's different ways people can slice and dice a carry trade. So you can rank currencies by some measure of carry, look at carry as a ratio of volatility to rank currencies in that way. You know, there's a decision around how many currencies you include. Is it just developed currencies, emerging market currencies? When you, you know, approached, you know, that problem of like, how do you, you know, pick the right construction? I mean, what was your thought process around, you know, around that?
Yeah, I think you're right. There are many ways to do this. You can volatility scale the interest differentials. What is the right interest differential? Is it
Yeah.
versus US interest rate? Is it versus global average interest rate? So there are many ways to do this. And then the issue of do you combine all currencies in one portfolio, or is it better to have a, say, G10 currency portfolio and currency portfolio? I actually historically and still today prefer the latter. I
Yeah.
think when you see these risk on and risk off periods that have been dominating since the financial crisis, EM often sells off altogether. So having an EM currency portfolio, long short, self-funding EM currency portfolio, to me is the advisable way to go, because the shorts in that portfolio help control the risk. And if you combine DM and EM currencies together, I don't like the risk characteristics of that, as well as the risk characteristics of a separate emerging market currency portfolio. And I think when you have the emerging market currencies, let's say you just take the 15 to 18 most liquid emerging market currencies, combine them, you have a nice portfolio that helps you get through the drawdowns.
Yeah. And then with something like momentum, I've always struggled with momentum strategies in the sense that it's hard to think about the theory around momentum. You know, with carry, you can think about it in terms of some kind of risk premia type approach. You know, so if you have kind of a finance background, you conceptualize, you can have some priors that kind of help you know, help moderate one's data mining instincts. Now with momentum, it's much harder to have those priors. I mean, there's some arguments around like a segmentation of market, different reactions to information, maybe, you know, different utility maximizing agents in the market, you know, the presence of central banks and so on. But all of them are very kind of behavioral or micro kind of arguments. So I've always found one has to kind of rely a lot more just on empirical sort of testing and try to kind of work out whether something is statistically robust. But that makes me a bit kind of hesitant about the strategy as a whole. I mean, obviously does you know, make money. I mean, how did you, you know, how did you tackle that one?
Yeah, you know, the statement you just made sounds a lot like an old BGI researcher, Bilal, that we understand our signals, you know, how do we explain this?
Yeah.
And with momentum, you can't explain it. Uh, but, you know, we've moved to an era now where with machine learning and
Yeah.
data science tools, we do hardcore data mining without apology, right?
Yeah.
We find these relationships and we don't know why. You can make up stories, I guess. But with momentum, I've always viewed it as unobserved variables. We're
Yeah.
capturing the effects of unobserved variables. There are things going on in the markets and in the world that we can't quantify easily. And so the momentum signals are a way to just an amalgam of these unobservables that we capture, and we get the influence that they're having on the, you know, something's driving the market, right?
Yeah.
So, and we try and measure what we can, but the nice thing about momentum is that it's capturing what we can't measure, and we're just saying something's pushing the euro up in value, and we're going to tell some stories about it and capture what we think are the fundamentals. But then we like to have momentum here beyond that because we know we're not capturing everything.
Yeah, absolutely. And kind of a near cousin, I guess, momentum is looking at flows and positioning and those sorts of things. It's very popular in markets for people to imagine that if you have some information on flows. So I used to work at Deutsche Bank and Nomura, JP Morgan, all kind of these major banks, and every single client category would always, want to get hold of our flow data with this idea that somehow it contains this secret source for making amazing returns. And then, the clients would tell me, look, I'm going to aggregate, your bank's flow with the JP Morgan, with the Citi, and then somehow this will give us this great signal. Now, you obviously worked at probably the one of the top of biggest asset manager in the world. So presumably you had access to all of this data. So what's your view on the value of flow and positioning data?
Yeah, my view is pretty pessimistic because we did have your data and our other counterparties' data, and I can think of at least 3 or 4 times when I had the research team working on flow signals, and not that we wouldn't trade them once in a while, but it is really challenging to get anything out of the flow signals. And why is that? I've thought about it quite a bit, and each bank has their own idiosyncratic clientele
Yeah.
and client base. Each bank measures their flow data differently, and no one gives you their raw flow data, right? Because no one's going to show you what are we actually doing in our business. They all standardize it, normalize it, convert it to some sort of signal that hides the true size of what they're doing, but gives a flavor of the direction and the size. So that's another issue. So ideally, as a researcher, you'd like to have the raw data and then
Yeah.
feed yourself to extract information from it instead of taking what the banks give you. And so I remember the last time I did this, I had a research assistant from Berkeley working for the team. And I thought, well, maybe the answer is, let's see if there's a common factor we can extract from all these banks, and we'll try work on that. And, to me, the answer is, if I know the flow data before it occurs, there's alpha there.
Yeah.
The flow data after it's occurred, and
Yeah.
it's not useful. I think the best shot you have nowadays for this is the CLS data, because CLS is, as a clearinghouse, it's collecting the trades of many different entities in the market, and they're splitting it up into, different categories of the entities. So probably the best bet for getting information out of flow data sources, probably something like the CLS data that is a more comprehensive view of the market. And nowadays, I believe they're making that available intradaily to customers. So, if I was working on a flow signal right now, I'd probably want the CLS data, and I would be working with those data, but flow data are really hard to use.
And when you looked at flow data, did you also look at non-FX flows, like all the custody data of equity flows, bond flows? Does the same thing apply to those data as well?
Yeah, I think so. I think so. You know, you always get the flow data with a lag. And so you have to believe that there's momentum in the flows and that the flows are going to continue in the direction where they have gone. Or alternatively, you can use the flows to build up positioning proxies as risk metrics to use as an indication of when you've gotten into a crowded trade. And then you may want to start cutting your positions if you're in that crowded trade along with many others. So I think flow data can be useful in that sense as an indicator of you know, when a trade is getting crowded. And I've been working with the CLS data in that regard for a new paper that I'm working on with a fellow at Stanford and someone in London. And it looks promising to me at this point that building up a positioning indicator by accumulating the flow data can have value in helping to control the risk of your currency portfolio.
Yeah, understood. And in terms of, you know, regime changes, you know, I just wanted to sort of pick on two that could potentially impact, you know, these, you know, trading models or trading returns, or just for any asset class. You know, one has been the onset of QE and zero rates since the global financial crisis, and then the other one is the rise of China, you know, and what impact that has on you know, trading and investing. So on the first one, I mean, do you think that one needs to rethink anything with the onset of QE and negative rates in relation to, say, to currencies or other asset classes even?
Yeah, I think it changed everything. The way you traded currencies pre-QE era is quite different in my mind from the way you should have been trading currencies once the financial crisis was underway and the central banks began the QE era. And pre-financial crisis, you could build currency trading models that would be based upon cross-country differences in macro fundamentals. And you could do pretty well with models like that. But with the QE era and interest rates being pushed down to zero or even below, that ended. And so it was much more the risk on, risk off world where getting the central bank policy right was the important factor. I know Helena Ray at London Business School wrote a paper a few years ago after this started on the global macro factor is the Federal Reserve. And I think she's absolutely right. If you were getting that right, changes in monetary policy right, and you had the right view on that, then you were going to do okay in currencies in terms of, you know, switching back and forth between long the risk currencies like NOK and Aussie dollar and Kiwi and the safe haven currencies like yen and Swiss and US dollar. And then the problem is always the recognition that you've moved to a new regime.
Yeah.
It's easy to look back now and say, well, we should have been doing this. So sentiment became more important than ever. And getting good sentiment measures is more important than it ever was pre 2008, 2009, because, you know, the macro fundamentals matter. But now, well, I mean, interest rates are tiny or negative. The interest differentials are minuscule. So the traditional fundamentals like the carry trade, you know, they're not very useful and haven't been for quite a few years now. Not to say they won't be. And that I still don't believe this is the normal state of the world, but this extraordinary state of the world has persisted for far longer than I ever thought it would. I was looking the other day at a speech I gave back in 2011, and I was early in 2011, I was referring to, and when the Fed raises interest rates later this year, and, you know, because we all expected that.
Yeah, yeah.
And it just didn't happen, and it didn't happen, and it didn't happen. So, it's been an extraordinary period that has been very challenging for active currency managers. It has been a very tough time for active currency managers to add value. And if we get more differentiation in cross-country macro factors, then the traditional approaches to managing currencies, active currency management, will once again, I think, be useful, but they haven't been useful for quite a time.
Yeah. And then how about China, the rise of China? The renminbi market's become much bigger as well. Is that something, is that just a new currency that one can now use? Or is there something a bit more structural in terms of its impact on the market, do you think?
Yeah, I think both. I think
Yeah.
there is something more structural in terms of the impact on the market. Like, renminbi was added to the SDR by the IMF a while back. Is it a convertible currency like everything else in the SDR? No. So in some sense, you could say, what was that about? Well, it was about politics, and a really important country being recognized as you're a really important country. So we're going to put your currency in here. But, if you're actively trading it, you could be trading NDFs on CNY, or you can trade CNH, right, directly as a tradable currency. And so trading CNH, I think it's done very well since it was introduced and has achieved really nice volumes. And I think using a paper that I wrote recently is looking at since August 2015, when there was a devaluation of CNY against the dollar. On the same day they announced the devaluation, they announced the new exchange rate regime, where there would be a central parity rate set early each morning before the market opening in China that would be based on the previous day's closing price, market demand and supply, and valuations of other currencies. So a lot of, what does all that mean type stuff. But that setting of the central parity rate, I take as a serious signal of where the People's Bank of China thinks that currency should be trading. And so to me, I think it's a useful signal for trading the CNH, because the two track fairly closely over time. Yeah, they can wander apart from each other in the short run, and they do at times, but they tend to pretty closely over a longer period. So yeah, I've got a new paper on trading CNH using the central parity rate on the CNY as a trading signal for that. And if anyone's interested, they can find it on the Social Science Research Network. So it's
I'll include the link to this paper, and you mentioned the paper earlier as well. All the papers you referenced, I'll make sure to include links for in the show notes as well. And as for the more sort of structural impact on markets of China,
yeah, I think that as Chinese assets are added to the global indexes, the derivative currency trading is going to grow, and the volumes will be growing. Does that mean ultimately that CNY will be a tradable currency and we won't be trading it as an NDF? I don't think anytime soon. I can't see that the authorities are going to be willing to give up control of the exchange rate and let it be determined solely by market forces. Maybe that'll be the case. And of course, steps in that, doing that would of course open the gates completely to adding Chinese assets to the global indexes. And that's a step too far, though, I believe, at this time. So I think we're going to be trading NDFs on CNY for some time to come. And CNH will therefore remain an attractive currency. So I think structurally there'll be more volume. It will continue to grow because China just gets more and more important as a business force in the world. And there's an election in the US next week that could have a significant change on the US relationship with other countries. And contingent on the outcome of that election, we could see much more growth in trade between the US and China and deeper relationships in some different dimensions.
Actually, now that we kind of mentioned sort of the US election and politics, I mean, one question I've always have for people who follow very quantitative approaches is how do you incorporate political factors into models? So do you kind of take a view sometimes to say that, look, there'll be some political turbulence, so we have to dial down the risk in these XYZ markets, or do you just let the models kind of run as they were before, and the politics will be captured in some way in the models?
Yeah, historically, quantitative investors would, I think, always monitor markets, both political as well as economic, and would make decisions outside of the model, overriding the model. For instance, you're trading Thai baht and you see something happening in Thailand that your model doesn't see, and you know that, then you decide, we're going to dial down this position. Let's cut back the position in Thai baht, or we exit the position altogether because our model doesn't see this. So I think that's always been the approach from quantitative investors, to have a view on what's going on politically and be willing to make decisions to override the model. But nowadays, you can get closer to quantifying these things and automating this process with like natural language processing of news articles, central bank statements, political speeches, and extracting sentiment signals, if you will, from those texts in order to quantify those effects. I still don't believe that's going to be anytime soon a complete perfect substitute for the willingness to subjectively override the models for risk management purposes. But we've certainly made significant steps in that direction with the ability to employ such NLP type approaches.
And actually, now that you mentioned NLP, and earlier you did mention machine learning with respect to momentum models, what I'm finding with machine learning is obviously the technology has improved greatly, and it's almost a bit like econometrics, I find, where there's lots of off-the-shelf products that people can now use and also abuse as well. And so we're kind of at that stage of machine learning, it seems. I mean, how do you go about thinking about how to use machine learning in kind of a more sort of responsible way, so to speak?
Yeah, I think there's a real danger in grabbing things. For instance, in our Master Finance program, it's a hardcore quantitative program, as I said, that combines financial econometrics, financial modeling with data science. And so our students learn data science techniques and coding in Python. And it's, very often I'll have a student where we're working on a problem or they're working on a project, and immediately they say, well, we're going to use machine learning for this. And so because, there are subroutines they can call in Python that will do this work, and they have a rough idea of what it means. And so it seems like an attractive thing to do and the trendy thing to do.
Yeah.
Yet I also want the teams to understand when it is appropriate to use and when it is not appropriate to use. So there's a real danger of people employing things that they don't really fully understand. Yet at the same time, these are powerful tools. So to me, you want to understand applications for financial models. And let's say you're building a trading signal, and you're going to do it with, let's say you have some flow data. Let's stick with that example. Okay, let's see what we can find with the flow data using traditional linear econometric models. And all right, here's what we get with that. Now let's use the machine learning and treat that econometric model as a kind of a benchmark. Yeah. And we have a basis for comparison. So I like to run horse races of the machine learning applications against more traditional approaches to see the value added. I don't like to see someone immediately jump to a machine learning model application before doing something that's a bit more structural and interpretable, and then treating that structural and interpretable result as a benchmark to then use to see what's the gain from using the machine learning. So
yeah, absolutely.
Little plug here. Our students are trained to do what people want to do in the industry. If you're looking for a great intern or junior hire, contact me. We've got some very talented students. Thank you
Yeah.
for the opportunity for the plug, Bilal.
Yeah, no worries. Yeah, actually, we're actually looking for interns, so I might ask for some names after this episode as well. Actually, one thing I have found with machine learning is that one of the issues I find with people who do use it is that they don't understand the data or respect the data they're working with. They almost throw in data which they don't fully understand into the machine, so to speak, and then expect some kind of a result to come out. And I find the biggest challenge is not so much the technical coding side of it, is actually the data quality and understanding the data, like whether it's seasonally adjusted or not. Just the real the messiness of data still is there, and you kind of need to understand the inputs into everything.
No, I couldn't agree more. In fact, I usually ask students who are working on projects, say, plot your data, show me the plot. Imagine you sit there and do weeks or even months of work to find out there's an error in the data that you could have found right up front if you had just plotted the data to see, does anything look crazy here? And also it helps give you clues as to where to look.
Yeah.
Like right now I've got a team working on a intradaily trading volume project. And my first request is plot the 5-minute buckets of trading volume through the day across all the days in your sample. I want to see the average pattern of these. Let's see what that looks like. And then let's think about what we want to do to try and model this. But I agree completely. There's nothing more important than getting the data right. To me, there's also nothing more exciting than a new data set.
Yeah.
So, if you can look at something that no one has looked at before, you will learn things, hopefully, that no one has learned before. And I love new data sets, but making sure the data are in order is of the first order importance.
Yeah. And you mentioned looking at trading volumes in 5-minute buckets and things like that. And you've done a lot of work on the micro side of trading. You published a paper recently looking at trading frequency, trading rebalancing, and transaction cost, or T cost, as it's kind of more commonly known. What were some of the main findings you had with that work?
Yeah, this is a paper that's forthcoming in the Journal of Financial Markets. It's an academic market microstructure journal. So the paper is addressing cost of trading currencies. And many people don't appreciate that you have to pay to trade currencies, even people you think are fairly sophisticated. I remember one time at BlackRock, I used to sit on the same floor with our active equity team. And one time I was going for a walk with a fellow on the active equity team who said, wow, you're so lucky you don't have to worry about transactions cost. You're in currencies. And I'm thinking, what? Well, of course, we worry a lot about that. It matters. And then a friend of mine was doing due diligence, looking at maybe buying a active currency management hedge fund. And he was telling me, he said, I asked him, so how do you handle T costs? What do you do about T costs? And was told, oh, we're too small. T costs don't matter. And this was $1 billion under management that they were managing. So I just shake my head. It matters a lot. And so that's what this paper is about. In fact, the title of the paper is Preserving Alpha.
Okay.
The effects of trade size and trade frequency on currency returns. And what we do, the problem is most people will use a proxy for transactions cost in the currency market, that they'll take the top of the order book on EBS. Yeah. Look at the bid-ask spread from the top of the order book. That's fine. If you're trading $1 million, that's fine. It is good. And we show that in this paper. But if you're trading larger size, if you're trading 10 million, 20 million, it's not at all accurate. So what we were able to do here is we were able to construct the sweep to fill cost of trades of different size using the EBS order book. So having all the complete order book, we could construct, at any point in time or on any day, the cost to trade 1 million, 5 million, 10 million, 20 million, 25 million. And we're able then to come up with measures of what it would what you would pay to trade those different sizes and different currencies. And so then we show that. So we show estimates of, what those costs would be for the different trade sizes. And then we create portfolios and we show, for this particular momentum strategy, if you're doing $1 million trades, here's your alpha. If you're doing $10 million trades, here's your alpha. If you're doing $20 million trades, here's your alpha. In some sense, title could have been large trades, small alpha. So there's no question, there's degradation of the returns as the trade size goes up. And portfolio managers really need to understand this to understand the capacity of their strategies.
Yeah. I mean, I think one of the sort of PR issues around FX is, well, not an issue, but it's promoted that FX is the most liquid market in the world, with trillions of dollars traded every day. But if you dig a bit deeper behind the numbers, a lot of the numbers are composed of swaps and other sort of parts of the FX market, and then a lot of the volume is maybe in euro dollar, or maybe dollar yen even to some extent. But then when you start to venture further out to currencies like the New Zealand dollar, to Norwegian krona, which is commonly traded, EM currencies, the volumes really fall off a cliff compared to, say, euro dollar. And so this idea of trillions of dollars is there's some nuance around that as well.
No, that's absolutely the truth. And you need to size your positions accordingly. So like you want to cap your position on the Kiwi very differently than you want to cap your position on sterling or yen or certainly euro. So you can do much bigger size in euro than anything else without moving the market. The price impact of a trade in euro of a big size is pretty small, but the price impact of a trade in New Zealand dollar of a relatively small trade can be significant. So it matters a lot. And I've noticed you have been very humble about this because you made some great trade calls ago. And I remember you saying either LinkedIn or your blog or wherever that I saw it, that but if you said, but of course, these are an overestimate of the returns. If you're really trading this, it's going to be some order of magnitude smaller. So your humility is admirable. They were still great calls, Bilal.
I appreciate that. Yeah. But having worked with lots of trading desks, I mean, you just see it. I mean, I've seen it with clients as well. They tell me, when they've computed their T costs over the course of the year, it's a sizable proportion of their ex ante expected alpha. I mean, it's and I think the real pros really focus a lot on understanding the sizing of trades and things like that, and understanding liquidity in different currencies, time of day to trade, how often you should rebalance your trading model if it includes some of these less liquid currencies, which it's not as glamorous as some people might want, but I think it's really important. I think the work you've done in that space is really, really good as well.
Yeah, thank you. It is really important. Of course, nothing's more important than a good alpha signal. So the best risk model in the world and the best T-cost model in the world won't save you if you don't have good alpha signals. But if you have good alpha signals, the way you really harvest the alpha is to make sure you control the risk and the trading cost. And I was very fortunate. At BGI, we had pretty refined trading research back when right after I joined the firm. The trading research we had was very sophisticated. So we were optimizing our currency portfolio subject to transactions cost constraints, all the way along. And that wasn't being done very widely. I think it was pretty rare in 2005 to 2008, 2009. Nowadays, there are third parties that help people do that and provide post-trade and pre-trade analytics. So, it's become much more popular today, but it's still striking to me that there are still people who just don't get it, that transactions costs are going to cost you. And if you ignore them to your peril.
And just, I guess, kind of a related question. I mean, when you were at BlackRock or even now in your academic work, have you looked at the difference in trading futures versus OTC? Obviously, in FX, there are a number of currencies where there's futures markets in them. Did you use both markets or did you just focus on OTC?
No, if you're big like we always were at BlackRock and before that BGI, you're using forwards. So,
Yeah.
you're trading with your bank counterparties in the forward market. The futures markets are just not liquid enough. And forwards are so flexible, and the size that you want to do, you can do efficiently with a counterparty bank. So it's really the forward market. For smaller size or smaller portfolios, the futures are fine. Uh, they tend to be more expensive to trade, but for a smaller firm, they may make perfect sense.
Yeah. And
Hedgers, for hedgers, that's a different world, right?
yeah.
So for them, the futures may be fine.
Yeah. And, at the beginning of our conversation, we talked a bit about how to measure the performance of currency managers. And we talked about looking at, comparing the performance of currency managers to styles, whether that's the appropriate benchmark. And you said you had strong views. So let me pick you up on that. So what is your view on how to assess or how to benchmark currency manager performance?
Yeah, this has always been an issue, and I didn't appreciate what a big issue it was till one time I was in London meeting with currency clients, and one of the pension funds CIOs had brought along his consultant, and the consultant raised the issue of why are we paying for active currency management in excess of what we could get from a carry trade or a momentum, because there
Yeah.
had been a paper written about there are these generic signals. Nobody should pay for active currency management if you're just getting the return on generic signals. And so that got me started on it. And I actually wrote a paper with my colleague, my BlackRock colleague, Duncan Shand, on this issue, because I think to talk about benchmarks for active currency is a very slippery area. First of all, there is no buy and hold. There's nothing like the S&P 500 or the MSCI Global Equity Portfolio. You can say, okay, there's our benchmark for our equity portfolio. There's nothing like that in currencies. There's no such thing as buy and hold, right? You're always long one asset and short another asset on a currency trade. So then, okay, well, what about carry, momentum, and value? Let's construct that. Well, there are so many different constructions, as we've already said.
Yeah.
And what Duncan and I showed in our paper, this was in the Journal of Portfolio Management back in, 2000, sometime 2000, maybe 12 or 13, that the different constructions will give you a different result. And alternatively reasonable constructions will give you different results on what is alpha and what is beta in the currency market. So I think it is very dangerous to say, well, let's see, I don't want to pay anybody for just giving me carry, momentum, and value exposure. If somebody's good at timing, carry, momentum, and value, you should be willing to pay them, because if they have skill timing those, that's alpha, that's not beta. So I think that's the difficulty, that measuring active currency managers against a benchmark is extremely challenging. And you can come up with some benchmarks, but I can come up with some alternative benchmarks that are just as good and just as reasonable that will show different results.
Yeah. And so, for assessing currency managers, then is it the best thing is just to take an average of the performance of different managers, like a peer group analysis? Is that a better alternative?
Well, certainly to succeed, you need to beat the return on cash, right? Which is
Okay.
very low
Yeah.
these days. But you've got to have positive returns and risk-controlled returns. So something like, show me the information ratio across different currency managers. Show me some drawdown measures across different currency managers. So if I'm looking to hire, say, 2 active currency managers from the universe of active currency managers, I want to see their performance over time, their information ratios, their drawdown statistics to assess who has skill. We'll never know who really has skill looking forward, because people can get lucky and have a good run of performance. But I want to see their performance over different market regimes to assess, these guys seem to know what they're doing and are doing a good job, or at least have historically. And then the best you can do is say, based on the past performance, I like their risk-controlled returns. So to me, that's how I would assess currency managers.
Yeah, that makes sense. I think we've covered a lot of ground. So, I'll like sort of change tact a bit and get a bit more personal. And this is, again, a question I like to ask all my guests. One is just around managing, information flow and, your own content that you receive all the time. I mean, we all feel a bit overwhelmed, just the volume of research that's produced, content in a broader sense. There's Twitter, academia, everything's online now, so it's much easier to get access to everything. I mean, how do you manage your information flow?
Yeah, that's a good question. Every day I read the Financial Times. Well, I should say I skim the Financial Times. I read what is interesting to me and what seems important and relevant. So I always read the Financial Times. And then I get some sell side research still. And there are people on the sell side who I think produce useful information. So I follow them. And I look every day or whenever they put something out, look at what they have to say. And then beyond that, I very selectively will open up certain messages or go to certain sites to look for information. But that's it. That's my daily budget for information acquisition. And then as things come up, then I'll go dig into finding information as it's needed.
Okay. And how about on the working paper academic side? Do you have, do things, I guess, probably get sent to you, or do you just rely on your own sort of primary research?
Yeah, well, I get the updates from the Social Science Research Network on the various topics that I follow, and I get those every day. So I can see the titles and the abstracts of all the new papers being posted to the SSRN. And I'll skim those very quickly. And if something relevant should appear, then I'll read the abstract and maybe go deeper. So that's how I keep up with the flow of new things coming out on the academic side.
And then on the kind of productivity side, I mean, how do you make sure that you're still productive in whatever your sort of metric is for productivity, whether it's, number of research notes or so on? I mean, how do you make sure that you produce, what you want to produce and not have too many kind of inefficiencies over the course of your day or your week?
Yeah, well, of course, the activities that I'm involved with, besides research, I also have administrative duties and teaching duties at the university. So, these are things that I have to deal with every day. Like I'm teaching right now. I'm teaching an independent research class where I've got 22 teams of students conducting research, and some are working on currency market research that are quite, I would say, using advanced methods and doing very interesting things. So I have to help them almost every day in various aspects of their research ongoing. And then administrative duties, like right after my meeting with you, I have to go to another meeting at the business school, the School of Management, where I'm affiliated. And these duties, I have scheduled events, like there's a class time where you've got to show up. And of course, now it's virtual, and meetings. It seems to me that the cost of meeting has been lowered by having virtual meetings, because I get more requests for meetings since we went virtual than I ever had in person at the university. So this is an ongoing issue every day, the administrative meetings that I have at the university. And then around that, I do the research. And, I learned very quickly when we were all sent home, things I took for granted in my office. When I moved home, I had my MacBook Air laptop computer, and I knew very quickly this wasn't going to work. I don't have access to my big desktop and multiple screens that I have in my office at the university. So I very quickly bought a new desktop computer and a big screen for my home office so I could continue to maintain my productivity. And then I also had to buy a top-notch router in order to, as I've got two daughters at home doing their schooling remotely.
Yeah.
So I had to make an investment in some hardware to maintain the productivity once we were all sent home.
Yeah, makes sense. And then finally, I love reading books, and so I always try to get book recommendations for people. But have there been any books that have really influenced you, historically or even currently, when it comes to your field of work or even at personal level?
Yeah, professionally, there's one that stands out because when I left academia, I stepped right into the fire, right? Because I
Okay.
was in charge of currency hedge funds and building active currency portfolios. And there's a book by Grenold and Quant called Active Portfolio Management, which is kind of a how to build a quantitative investment portfolio. And it's very much equity centric. So, and that's fine. But they go through, here's how to construct a portfolio and here are appropriate risk management tools and, so kind of step by step. And it's not like a cookbook where you just follow a menu, but it gives you a very nice overview of quantitative investing. So I read that book very quickly after I started at BGI to get an and also Richard Grenold was the global head of research at BGI and a very nice fellow who initially was my boss when I first joined the firm. So I read his book with great interest, and Ron Kahn, his co-author, he and I team taught at Berkeley. His PhD is in physics, but he would teach finance classes at UC Berkeley, and we were team teaching for a while together. So they produced a wonderful book that influenced my professional approach quite a bit and was very useful to me in shaping my views of how to appropriately model currencies in a portfolio construction. And then personally, well, I'm in La Jolla, so this sounds like totally California, dude, but I was on a surfing trip once, and a friend gave me a book that he had just finished called Autobiography of a Yogi. And so I started reading that book, and it was a very thick book, but on a surfing trip, you have lots of leisure time when you're not surfing. And so I read this book pretty quickly, in fact, and it really changed the way I thought about life, and it had me start to think about meditation and, basically the realization of what's really important in life versus all the noise. So on a personal level, that book had significant influence on me as a young man.
Okay, yeah, no, I've heard of a few other people have recommended that book as well. I've never read it yet, but now I think I will have to now that you've also recommended it as well.
Yeah, and it's very dated because this fellow, his name was Paramahansa Yogananda, was a yogi in California in the 1940s and built a following here and has a temple in Los Angeles, I think in West Los Angeles, and has the temple down here in Encinitas, just north of San Diego, which is actually right located on a very famous surfing break. So, and they named the surfing break Swamis after this. So this book written in the 1940s, it's very interesting because it's all in the context of that era.
Yeah.
Before the Beatles went to India and, this
Yeah,
Eastern.
I didn't realize there was that type of movement before the 60s. So that's interesting in itself to learn that there was the beginnings of something in that period.
Yeah, but I think it was very much more esoteric and viewed as more eccentric at that time, but also viewed perhaps in more of a non-judgmental way.
Yeah.
Because, he was viewed as a religious figure
Yeah.
and I think had an influential following.
Yeah. Okay, well, on that kind of sort of non-materialistic note, it's great to kind of wrap up our conversation. So just first, I wanted to thank you for your insights over the conversation. But then also, what's the best way for people to follow your work?
Well, as I say, the new papers tend to be posted on the Social Science Research Network when they reach a certain stage of maturity. The one that I'm working on right now on flows, the CLS flows data, I haven't posted publicly. So, I mean, I'm happy for people to get in touch with me, mmelvin@ucsd.edu. So mmelvin@ucsd.edu. That's fine. Again, if I can help, if someone's interested on the research side or in talking about one of our students, always happy to. I love, I'm staying very close to the industry. It changed my life moving from academia to VGI and BlackRock. As I said earlier on, I didn't know what I didn't know. And my years in the industry have influenced my research dramatically. And what I work on today is implementable. Unlike what I worked on before I was in the industry, when I would just come up with what I thought were clever models, but I never thought about, could someone really trade this? So it's very important, I think, that academics work on things that society can use.
Yeah. Yep, that's a good note to end on there. So once again, so thank you very much, Michael. It was an excellent conversation with you.
Thank you, Bilal. It's great to see you again.
Right.